I hope everybody's doing well today. I want to talk about the Daily Trading Podcast. And so originally we had this podcast because I wanted to put on a podcast and on a YouTube channel and just put the same videos out. But over time, that wouldn't turn out to be a good idea because you had two separate communities and would want everybody watching both instead of watching one or the other. So what I've decided to do is that since audio is easier to make and edit than video, I'll put less videos on the YouTube channel, maybe only post twice a week. But then on the podcast, I will go and every single day that the market is open, I will post a podcast. And so, what is it? It's going to include my full watch list, price action analysis on major tickers, macro fundamental analysis, multiple bottom up fundamental analysis, Vega analysis, market profile analysis, and risk management. And so, just going over the current episodes. Oh, and by the way, before I even get into that, originally we had a teachable classroom that we wanted to open, but instead now I've decided that I should do it as a podcast instead and give this information as a podcast. Makes it a lot easier because podcasts are free for me to make and they're free for you to listen to. And so Teachable actually took a cut out of everything, and so I didn't want to have to charge you for it, but at the same time, I didn't want to have to pay money for it. But podcasts are a lot better because they're free for me to make and they're free for you to listen to. And then any newsletters, I want to do a newsletter. Newsletters are now going to be on Seeking Alpha, and you can go check them out over there. And so let's go over the podcast episodes I've done so far. I did one way back in January. It's called Predictions 2020. You can go check that out. And as the title suggests, it is my predictions for 2020. And so there was that one. On Thursday, I did a podcast that essentially talked about what's going on in the markets and did a options trade. It was a front ratio spread. It was a put front ratio spread on the Qs. And then Friday, I did a episode on Berkshire. And so that episode on Berkshire, that was more of a value investor type episode, longer term. It was a bottom up fundamental analysis. So it was really my bullish case for Berkshire. And then what I plan on doing is that on Monday, I plan on doing a macro analysis and really talk about the history of the monetary system, what I see going forward. That's going to be more longer term macro, but I will get into the shorter term too, which is more important if you're trading. And then Tuesday, I want to go ahead and talk about pairs trades. And pairs trades are great because let's say that you were long the S&P 500, which has now gone down 40%, but you had listened to one of our videos and you had pairs traded something against it. So one of our shorts was actually Boeing. And so we came out on, I would say, 5 weeks ago, and basically did a Boeing valuation. We said the Boeing is way overvalued. And so I came out with a Boeing valuation, and our thesis from that was short Boeing. Well, if you had shorted Boeing and then hedged against it by taking a long position in the S&P 500 in case the market kept on going up, because in all of 2019, Boeing actually went up. It was a very small amount. It only went up 3%, while the whole S&P 500 went up over 30%, but it still went up. And so you could have taken a short position in Boeing and a long position in the S&P 500 to hedge. And so if you did that again, when we did that video, you had long positions in the S&P 500, shorted Boeing. What that would have resulted in was that Boeing went down 80% so far, and if it weren't for the government bailing it out, it would go bankrupt. And the S&P 500 has only gone down 40%. So you would actually make the difference between the two, which is 40%. And it's a lot better way to trade because it's a lot less volatile. And because you were taking a long position in one cyclical, taking a short position in the other, doesn't matter if the whole market goes up. If the whole market goes up, Boeing might only go up 10%. The S&P 500 might go up 20%, just like how throughout 2019, the S&P 500 went up almost 40%, but Boeing only went up 3%. And similarly, in 2020, when the whole market went down, Boeing went down just about 40, well, the S&P 500 went down almost 40%. Boeing, though, went down 80%. And so that's an example right there, pairs trading. And we'll be talking about that on Tuesday. Wednesday, I will be doing a crypto episode. And so just all these things right here that we have. Watch list, price action analysis on major tickers, macro fundamental analysis, bottom up fundamental analysis, Vega analysis, market profile analysis, risk management. Okay, so what are the products being used? Futures, options, stocks, crypto, commodities, forex, fixed income, exchange traded funds, exchange traded notes. So I want to use all those products right there, and possibly I might talk about spread betting or CFDs, just because I see that I have a European audience and somewhat of an Asia Pacific audience, and they don't use futures and options. They use CFDs and spread betting largely, and that because futures and options largely offers leverage. And so people in the United States tend to use options because it has implied leverage. Futures has span margin leverage, which is a lot better than Reg T. People overseas tend to use CFDs and spread betting, so I might include some of that too. Okay, so option strategies included. If you don't already know, I'm sure many of you already know, options are a big part of what I do. Risk reversals, iron butterflies, ratio spreads, butterflies, broken wing butterflies, unbalanced butterflies, long short verticals, collars, naked options, time spreads, diagonal spreads, front spreads, intermarket spreads, box spreads, and back spreads. So we've got a long list right there. And they're for both beginner and advanced traders who want to strengthen and learn options for swing trading, for speculation, income, and hedging. So right there, as it says, beginner and advanced traders who want, that's a typo right there, that should be want, to strengthen or learn options swing trading for speculation, income, and hedging. Speculation is higher risk but higher reward. Income is very conservative. You can make 40% a year in a very conservative manner. And then just hedging all your stock positions. Of course, you can hedge with pairs trading, which is also another great way. Right here, I want to talk about the option strategies because your analysis can be wrong, yet you can be right. And that's the great thing with options. That's why I encourage people, especially beginners, to actually use options over using the underlying itself. The reason as to why is because, say that the market goes down, and the market goes down 5 to 7%. Or, well, it did actually earlier. The market was down 5 to 7% a couple of weeks ago. Now it's down almost 40%. Brussels down almost 50%. But if it was just down 5 to 7%, when it was down 5 to 7%, many people wanted to buy the dip. They said, oh, well, it's down 5 to 7%. I should hypothetically just buy the dip, as it has worked every other time. And so people went in and they tried to buy the dip. Well, their technical analysis was wrong, and maybe your technical analysis is only right 70% of the time. And so it was that 30% time that their technical analysis was wrong, and the market did not buy the dip. And they lost money because they bought stocks at the time. If instead you had gone out and you instead used callback spreads, not just would you get a bunch of implied leverage, even though you were wrong on your technical analysis, that because it was part of the 30% of the time that you were wrong, you would have not lost money. Because back spreads are made in such a manner where if the price goes against you, you don't actually lose money. And so with a back spread, it's like a hedge. It protects you. And so if you're wrong, you still don't lose money. And so this is what I mean right here with option strategies that can do this sort of a thing where not just does it offer you leverage, which is why many people use it, it also offers you protection in the sense that your analysis might only be right 70% of the time. If your technical analysis or fundamental analysis is only right 70% of the time, well, the other 30% of the time you're losing money. Now you could cut your losses with stop losses, although I don't prefer that. I think the options are a lot better to use than stop losses. I will be making a video on stop losses later though. Or you can try and change the amount of times you're right. So let's say that you only win 70% of your trades because you're only right in your technical analysis 70% of the time. But by using option strategies like this, where you can find out the weaknesses and the strengths in your technical analysis, you can come out with payoff diagrams that and curve fit those payoff diagrams to your particular technical analysis. And so if doing your technical analysis, now you think that the underlying is likely to go up, and you might have thought that when it went down 5 to 7%, that it was likely to go up, but simultaneously it might go down, but the price won't stay the same. You could have used a back spread. And so you've now skewed the payoff diagram. And so now instead of winning 70% of the time because your technical analysis is only right 70% of the time, you instead win 95 of the time, because even though your technical analysis is only right 70% of the time, when your technical analysis is wrong, you still make money. And so that's the great thing with back spreads, is that even if you're wrong, you can make money or break even. And many of these spreads right here have similar things to them. And so credit spreads, for example, that's type of short vertical. That is also something that has that, where it can move against you. The underlying can move against you, or the underlying price can stay the same, but you still make money. And so those are just reasons that you want to use it. And I think I get into that inside the next slide right here when I talk about the goals of the podcast, is to teach traders how to see risk-reward probability ratios. You want to see those ratios to the point where even though your directional analysis is wrong, you can still make money. And then we want to talk about how traders can use options to skew payoff diagrams. Again, this is the same thing with payoff diagrams. If you think that the price is very likely to go up, the price won't stay the same. That's the most unlikely scenario. And the price is also somewhat likely to go down, but not as likely. Callback spreads are great. And so that right there, just talking about how to skew options payoff diagrams to your particular analysis, and knowing your strengths and weaknesses in the analysis, and taking care of the weaknesses and using the strengths. So now, instead of winning 70% of the time, because before you won 70% of the time because your technical analysis was only right 70% of the time, now you're going to win 95% of the time because you use options to hedge and speculate in such a manner where you lose very little, you gain a lot, and your probabilities are on your side. On top of that, you're able to roll losers, manage winners, and if that isn't enough, you're able to skew it in such a manner where if you're wrong, you still make money. And so what strategies to use in every situation, how to systematically make a watch list of underlyings, that's more for beginners, but it's still good for advanced traders to listen to. How to manage risk, that one, many people don't know what the Kelly criterion is. You really want to use that. Hedge positions efficiently, speculate for less than 1% of the value of an underlying while still having the same upside. And this one is one that many traders need to learn how to do, is to spend very little. And so worst case scenario, they only lose 1%. In best case scenario, they make a lot. And so they're risking very little to make quite a lot. So risk less, make more. So where can I find the podcast? There's going to be a link in the description below, link in the comments section, pinned to the top. Anchor, Spotify, Breaker, Apple Podcasts, Google Podcasts, Radio Public, and Pocket Casts. If you have any questions, go ahead and ask me inside the comments section. Anything about what type of strategies we might be using, just anything about going in the market, anything about the markets right now. If you have any questions about what's going on in the markets, go ahead and ask me that too. And these questions could just be anything. So, like, for example, why is gold going down? Because I know that's a question that I have for some reason. Which it's a logical question, but many new traders are asking that right now, and some traders are asking me, and so I feel that many people on this YouTube channel, they actually use gold and silver to hedge, because I personally use that as a hedge against the market, but it also started to go down. And so it can be a simple question like that, or it could just be, hey, I got a brokerage account, and what's the difference between Reg T and span margin? If you don't actually understand that, or I talk about that today and you didn't understand what that meant. And so if you have any questions like that, go ahead, put them inside the comment section below. Any questions about this podcast? The podcast name is just going to be Alpha Action, the same name as this YouTube channel. And I'll also be on Seeking Alpha, putting on newsletters, and I will be under the same exact name, Alpha Action. And so any questions, comments, put them inside the comment section. And anything else that you may have, go ahead, put inside the comment section. I will be down there answering everything. Thank you for watching. I hope you have a great day.